Looking at the market, there seems no end to the positivity today, and the JSE All Share closing up nearly 2%, 28,880 points or so. Your view in terms of the positive sentiment as we hit this Monday hard, is it sustainable?
Evening, Bronwyn. In the immediate, yes. I mean, I think our market's going to run some more. I've been saying I think the all share can probably get to around 30,000 again, but I don't think it can get much beyond that. Really, what was driven today was PMI data. China came out with a below 50 number, which on the surface is bad, says contraction, but China's trying to take some of the froth out, slow down their growth, and that kind of says they're succeeding, and the market then says, well, now they can perhaps start putting some growth back in. And then all the European PMI data, the ISM out of the US was all above 50. The one bad spot there is South African PMI, which came in below 50, but ahead of expectation. And that really has got the market bullish and optimistic.
And the South African PMI also coming ahead of that June number of 48.4 rather, to that 49.5. So at least in a positive direction, despite the fact that it is in contraction. The PMI number out of China, when I saw that come through this weekend, I immediately anticipated we would see a sell-off come Monday morning. But as you say, that's not the case, and it looks as though the market is saying that this is an expected decline in momentum rather than something which is going to prompt or override the global recovery.
Absolutely, and if we step back a moment, it's one thing I always say to folks is, when data come out, let the market decide how to respond, because we can sit down and scratch our heads and think we know, and the market will prove us wrong more times than not. And it was that theory that the Chinese government has been trying to slow down their growth, and as we always say, slow for China is 6 or 8% growth. It's still a huge number. Trying to rein it in a bit, worried about bubbles all over the place forming in the Chinese economy, and the market took it a view as that they've succeeded at that, and therefore they can sort of let go of some of the strings, and the economy can perhaps gain a bit more momentum going forward. So in truth, they took that number below 50, which is contraction, and actually took it as a positive news.
Mike Brown from Nedbank, relatively cautious on the second half. The stock is up in line with the broader market today, up 1 1/5% at 136 Rand or 135 Rand. What do you make of Nedbank? As I said earlier, I was speaking to Sanlam Investment Management Claude Cake, and he sees that if you look at the big four banks, we're looking at fair value across the board.
I think so. I mean, if we drill into the numbers, the headline earnings per share was marginally behind what we were expecting. And in fact, if you really drill down, it was Imperial Bank and then Central Services and the like that really saved the day for them. But the banks are still coming out with ugly numbers. We're going to expect that. ABSA said last week they were looking at headline earnings being down. Fairly valued, yes. I mean, we've got a one-year price target of about 150, 160 in Nedbank. We're still running through the numbers today, but at a quick glance at them, that's what we're looking at. Nedbank 135, that's giving you about 10%. We're expecting more from the market. So probably fairly valued and going to move in line with market going forward.
We've got ABSA out with results this week, also African Bank. Any thoughts on that front before we move off the financials?
The ABSA number was interesting. It wasn't so much that bad debts has kind of slowed. What the comment from them was, and they said it's going to be slightly negative, the comment was that consumers aren't picking up new loans. And kind of we can see that in the public sector credit extension numbers. The consumer isn't out there taking on more debt. And I think that's actually not a bad thing. Bad debt and delinquencies, as we call them these days, have kind of like slowed and is now trending in the right direction. And consumers aren't running out to get more debt, which shows that they're being a little more careful.
Simon, you're referring to the trading update out on Friday, where headline earnings per share were to be 3 to 5% lower from an ABSA perspective. Is that correct?
Correct. Yes.
In terms of the broader market now, what is your opinion?
I mean, run really, really hard, and I was drilling down also into some of the moves year to date, etc. Best performing sector year to date has been financials, which surprised me. Resources have been slightly in the red year to date, and I think resources might be the one space to watch. There are a couple of issues there, none the least our rand moving stronger down into the mid 720s. A lot of people are saying 720 itself is really the key number to watch. And then, of course, what does that recovery look like, particularly in China? Do they get the growth back on track, get it closer up to that 10 or 11 rather than the 6 or 8? But certainly resources have been lagging to a degree. And what we also saw today is appetite for emerging markets again, appetite for risk. Sort of the European markets did good, but there was a lot of volume going through in emerging markets. So I think we're going to probably see a bit of a broad rally, but I think it might be more focused into resource stocks.
As you say, perhaps the rally more focused into resource stocks. And I'm going to ask you to be more specific than that. Where exactly are we going to derive benefit from resources?
Resource stocks, to me, is fairly simple. It's Sasol. It's probably almost Sasol. It's moved it a lot, but we got all up at 80. Sasol looking particularly well positioned there. Like Platinum, and in that point, we particularly like Implat. It's sort of like just ahead of Anglo Plat if we had to pick between the two. And then your big diversified, we've always liked Billiton. We still like Billiton, and certainly we would look at those three as a good place to get some resource exposure.